In this video, we're going to take a detailed look at the short interest chart and discuss what short selling and short squeeze actually mean, and whether these can really be used to predict a company's or a stock's short-term future. So far on this channel, I've analyzed and shared early-stage insights on over 60 companies like AMPX, Rigetti, Wolf, and Hive, and most of them have brought us hundreds of % in profits since those days. I've also made a promise to myself that I'll do my best to help my viewers grow and improve in this field. That's why I've created a new playlist on the channel called Stockmarket Lessons, where I share lessons that will help you build real knowledge in stock investing. I'll be adding this video to that playlist as well, so make sure to grab your notebook and pen, take notes, and watch those videos one by one. Now, let's get started. To answer this question properly, we need to look at the topic from a broader perspective, but first, we need to understand what this concept actually means. In general, the short interest chart is closely followed by many investors, as they believe it helps them understand the psychological and technical direction of the market. More specifically, short interest shows how many shares of a certain company have been sold short by investors. Short selling means that an investor borrows shares and sells them, expecting the price to drop so they can buy them back later at a lower price and return the borrowed shares, making a profit from the difference. In simple terms, the investor is betting on the stock's price going down. For example, imagine a stock is trading at $100, and you borrow 10 shares from your broker to sell short. That means you've sold $1,000 worth of shares that you owe back to your broker. If you're right and the price drops to $80, you can buy back those 10 shares from the market for $800, return them to your broker, and keep the $200 difference as profit. You can do this with a simple click, just like a normal stock trade, but your broker needs to support short selling, and that varies depending on the platform. On top of that, the exchange where you're trading must also allow short selling. For example, in US markets like NYSE and NASDAQ, short selling is generally unrestricted, although temporary bans or limitations have been introduced during special periods or crises in history. Let me explain this in more detail. In major US markets like NYSE and NASDAQ, short selling is permanently legal and widely practiced. However, these activities are regulated by the SEC and FINRA. In certain historical moments, such as the 2008 financial crisis or during the 2020 COVID pandemic, markets temporarily restricted or banned short selling. The short interest chart usually displays two main data points: the total number of shares sold short, and the short interest ratio, meaning how many days it would take on average to buy back and cover those short positions. For example, if a company has 100 million shares in public float and 10 million are shorted, that's 10%. There's no fixed standard, but generally speaking, when this ratio is between 0 to 5%, the market is calm. Between 5 to 15%, it's considered uncertain, and around 20%, it's viewed as pessimistic. If more than 20% of shares are sold short, it usually means that the crowd expects the stock price to fall. When this number exceeds 30%, it often indicates potential for a short squeeze. Again, these numbers are approximate. So, what is a short squeeze? If a stock's short interest is very high and the price suddenly starts rising due to some news, short sellers panic and rush to buy back their shares to cover their positions. This buying pressure pushes the price even higher, like a rocket, and that's what we call a short squeeze. This is exactly what happened with stocks like GameStop and AMC back in 2021. Let's look at the GameStop story. Before diving into GameStop's famous comeback, let me remind you, my goal is to reach 1,000 subscribers by the end of the year, and if we hit that milestone, I'll reveal every single company in my portfolio that has brought me significant profits. So if you're interested, make sure to subscribe and help us reach our goal together. Now, back to the story. At the end of 2020 and the beginning of 2021, GameStop, a retail chain for video games, was struggling. With digital game sales on the rise, its traditional business model was weakening, revenue was declining, and investor confidence was fading. Hedge funds, including the well-known Melvin Capital, saw this as an opportunity and started opening short positions, believing the stock was overvalued and bound to crash. But something strange happened. GameStop's short interest level exceeded 100%, meaning there were more shares being shorted than actually existed in the market. In other words, investors were so confident the stock would collapse that they practically overloaded the system. This caught the attention of retail investors on Reddit's r/WallStreetBets forum. They saw it as a chance to fight back against the big hedge funds and began buying GameStop shares in massive numbers. Social media exploded with slogans like, "Hold the line," and "We like the stock." As buying pressure grew, the price skyrocketed, from $17 to as high as $483 within just a few weeks. This was a textbook short squeeze. As the price surged, funds with short positions started taking heavy losses because they had to buy back shares at much higher prices. Some funds, including Melvin Capital, lost billions of dollars, some shut down completely, others were bailed out by larger financial institutions. The rally happened so fast and unexpectedly that popular trading platforms like Robinhood couldn't handle the demand and temporarily restricted buying of GameStop shares. This made retail investors furious, as they believed these restrictions were meant to protect the big players. As a result, volatility reached record highs, with the stock swinging hundreds of % in both directions within days. The U.S. Securities and Exchange Commission (SEC) launched investigations into potential market manipulation. In the end, the GameStop event wasn't just a stock explosion, it was a turning point in financial history. It showed that the power of social media and collective action could shake market dynamics that had long been dominated by large institutional investors. GameStop became not only a symbol of retail investors' rebellion but also a focal point in discussions about fairness and transparency in the markets. That's why I personally don't put too much trust in these indicators. Most of the time, such moves are driven by manipulation, emotion, and speculation rather than real value, and short-term market noise doesn't interest me much. I'm an investor, I like peace and quiet, and I stay away from the noise. In my opinion, short interest charts are short-term sentiment indicators. Using them to predict a company's future is nearly impossible. However, if you're planning a long-term investment and want to find relatively good entry points, taking a look at this chart might still be useful. Lastly, before we wrap up, if you'd like to earn up to $30 worth of free stock or cryptocurrency, you can sign up on the QuantFury platform using my invite code through the link pinned in the comments. And if you enjoy my videos, you can also buy me a cup of coffee through the other link pinned below. It helps keep me motivated to continue creating new videos for you.